When the crypto market is crashing, it can feel like you're doomed to watch your portfolio get smashed. But what if there were ways to trade downtrends that actually boosted your crypto returns?
Yeah, boy.
Well, that's exactly what we're going to look at today. In this video, we'll examine 5 ways you can improve your crypto gains no matter how bad the market may look. My name is Guy, and if you want to generate better returns even when the timeline is screaming that the end is nigh, this is one video you can't afford to miss. First up though, I'm not a financial advisor and nothing in this video is financial advice. This is educational content meant to inform you about how to improve your returns during crypto downtrends. If that sounds good, hit that like button and let's get into it. Alright, let's start off with the obvious method for profiting in a red market, shorting with derivatives. Now, we're not suggesting you head out there and blindly short a red market. If you have a compelling short idea, that's great, but that's entirely up to you and your judgment. Instead, we're considering a way you can generate returns on shorts without holding directional exposure. How does that work? Well, let's say you're holding 0.5 BTC, but you're also convinced the market is going to continue a downtrend, but you don't want to dump it into a panic. One simple way to use derivatives here is to hedge by shorting 0.5 BTC on perpetual futures at 1x leverage. That flattens your net direction. If BTC drops, the short makes money. If BTC rips higher, your spot holdings do. Now, you might be asking, okay Guy, so I'm in a neutral position. How am I supposed to generate returns? Well, you're in a position to generate returns because shorting perp futures includes funding fees. If you're not aware, funding is a periodic payment between longs and shorts that exists to keep perpetual futures prices anchored to spot prices. When perps trade above spot, funding goes positive and longs pay shorts. When perps trade below spot, funding flips negative and shorts pay longs. Exchanges distribute that payment at set intervals each day, and you'll see it change across the course of the day. If the crowd leans long, which is typically the case in crypto, funding skews positive, which means a hedged short can collect those payments while sitting in a delta-neutral position. That's the essence of the so-called basis trade. Now, fortunately for this strategy, funding spends far more time in positive territory than it does negative, even across crypto downtrends. Many exchanges anchor around 0.01% as the equilibrium, and you'll see funding oscillate around that level rather than sit underwater indefinitely. So, even when the chart looks grim, hedge shorts are typically netting a profit over time. One neat feature of perps is that they have no expiry, hence the name. So you're not racing a clock the way you would with quarterly futures or options. That lowers the timing stress. You can keep the hedge on as long as the economics make sense. Just remember though that funding is variable. In chop or panic, funding can flip negative for a stretch and turn your carry into a cost. Funding can go deeply negative during particularly bearish spells, so this is still a trade that needs to be managed. Don't set it and forget it. And speaking of particularly bearish spells, just keep in mind that exchanges can alter leverage futures positions at times of extreme stress and low liquidity. For example, during the last liquidation cascade that saw $19 billion wiped out, auto deleverage, or ADL, kicked in across venues. Now, ADL trims winning positions, yes, including shorts, to keep the books balanced. It's very rare, but it can happen. Now, when it comes to short ideas in a downtrend, options are another, option. An option gives you the right, but not the obligation, to buy or sell an asset at a specific price, either on or before a specific date, depending on the option structure. It's a clean way to limit downside while keeping upside beyond the premium you paid. The catch, though, as we briefly mentioned earlier, is complexity and timing. Being directionally right with options isn't enough if the move lands after the option's expiry or isn't big enough to outpace time decay. Now, there are ways to tailor options trades to optimize for such factors, but it's probably best not to go down that route unless you're willing to really get deep into the weeds. Therefore, for most, shorting perps with 1x leverage is simpler. Fewer moving parts, no expiry roulette, and you can farm positive funding in a straightforward manner. On a final note, counterparty risk is one overarching thing to consider. Stick to established venues with transparent risk processes and keep position sizing sane. Hedging's job is to reduce pain, not introduce new tail events because you went 50x on a hedge. So, whether you're looking to put on some shorts or simply hedge your exposure, it's best to use an established exchange such as 2bit. And if you use the link in the description below, you can get a welcome bonus of up to 100,000 USDT, as well as up to 50% off trading fees for life. All you have to do is click that link and it'll take you to 2bit's sign-up page with the special code baked into your sign-up. From there, simply create an account using your email, Google account, Apple ID, or Telegram. Once your account is created, your bonuses are automatically applied and you're good to go. Now, this deal won't be around forever though, so take advantage of it while you can by using the link in the description below or this QR code. Okay, the second method to boost your returns during a downtrend is a good yield strategy. If you're holding crypto assets, there are almost always ways you can put them to work instead of having them sitting idle. So let's consider ETH. Native staking pays you protocol rewards for helping to secure the network, all without giving up custody of your ETH if you choose to go the decentralized route. The APR you receive from staking your ETH depends on network activity and which staking provider you use. If we take Lido Finance, for example, the current APR sits at 2.6%. But your options don't stop there. Liquid staking takes this concept one step further. With Lido, you can deposit ETH and receive a staked ETH token, which accrues staking rewards while staying usable across DeFi. That receipt token can then go to work in money markets, DEX pools, and more. The things to be conscious of are liquidity and peg risk. In stress, staked ETH tokens have traded at a discount to ETH, which can technically blow up fancy staking loops and trigger forced unwinds. We saw some signs of that tension during 2022's deleveraging when Lido's staked ETH slipped below parity as big holders rushed for liquidity. Now, things eventually worked out there, but some over-leveraged users did get hit with liquidations. So, the takeaway here is that the peg can break, so be very careful if you're going to stack yields on top of yields. But staking isn't the only thing to look at for yield. There's also crypto lending. Here, you simply deposit crypto assets to lending protocols like Aave and collect interest payments. Aave remains the flagship venue for lending with battle-tested architecture that has withstood the test of time. And that's no exaggeration either. During the 10th of October market wipeout, Aave processed a record wave of liquidations automatically, about $180 million worth, without the protocol pausing. Very impressive. So, what kind of rates might you earn on your deposits? Well, in drawdowns, borrowers tend to back off, so supply APYs tend to fall. So don't expect double-digit yield on majors, but the idea is to earn on what would otherwise be idle assets. Also, APY soars when bullish sentiment returns and borrower demand rises. Now, that all sounds good, and it is, really. However, as always, risks are present. Protocols can face issues and price oracles can malfunction. Yes, Aave has withstood even the harshest of market conditions, but nothing is risk-free. Just bear that in mind. With that said, staking what you plan to hold anyway and lending some if you're so inclined can really help boost your returns even when markets are red. So let that yield roll in from your long-term holdings while your timeline loses its mind on the fourth consecutive red daily candle. All right, time now for the third method that can help you profit during those scary market drawdowns: arbitrage. When the market faces chaos, the same asset can be priced differently on different venues due to panic selling and differences in liquidity conditions across exchanges. That gives you an arbitrage opportunity. Simply put, arbitrage means you'll buy where it's cheap, sell where it's less cheap, and keep the difference. The cleanest setups often show up after those major leverage wipeouts, such as we saw on the 10th of October. There are also times when stablecoins can depeg in DeFi due to stretched systems and liquidity. For example, we've seen Curve and Uniswap pools overrun by one-sided flow, pushing a dollar stable closer to 99 or 98 cents on-chain, while centralized books still mark it at $1. Traders who had inventory on both sides hoovered up the basis until pools rebalanced, probably the easiest returns one can make in such a short stretch of time. Now, execution risk is where most would-be arbitrageurs get humbled. In heavy volatility, centralized venues run into issues precisely when the spread is juiciest. And to a large degree, the arbitrage is juiciest specifically because exchanges are having issues. So, in such scenarios, the key is to keep a very close eye on exchanges so you can pounce when things are back to running smoothly. Focusing on-chain, the key element to consider here is gas fees. When stress hits, fees will invariably spike hard, turning what would be a profitable arbitrage into a loss-making venture. And that's not including any slippage as prices move sharply. It's also important to remember that you're competing against others here. Everyone wants that free money. So how do you actually pull it off? Well, first and foremost, try to pre-position capital. Keep funded accounts on at least one centralized exchange and one decentralized exchange per chain that you trade. That means you're ready to strike whenever a good arbitrage opportunity arises. From there, just be conscious of withdrawal queues, deposit settlement times, and all associated fees before you start any arbitrage trade. When the market gets chaotic, inefficiencies get exposed, and the edge goes to the trader who is prepared to take advantage of that fact. Now, the fourth method to counter a red crypto market is simple but effective, and that's buying other assets and asset classes that are rallying. As the saying goes, there's always a bull market somewhere. If crypto is risk-off, but other assets like stocks and gold have been making new highs, you may simply be better off looking for long opportunities in those upward trending markets. You won't necessarily have to shift capital either, as both crypto sexes and dexes offer tokenized stocks and gold as well, just FYI. Let's consider crypto's performance in September and early October. During that time, crypto struggled with choppy price action that ultimately resulted in a big long leverage wipeout. Meanwhile, gold was relentlessly powering through to fresh all-time highs. Now, we're not saying you should full port into gold. In fact, all the footage from around the world of people queuing up to buy gold probably means things are at or close to a peak there. However, this is a simple reminder that there is always a bull market somewhere, and it's often not that hard to find. It's also a reminder that there's an ebb and flow here, and Bitcoin will once again be center stage as Gold 2.0 once bullish crypto sentiment returns. That said, one other thing to consider is that just because BTC is trending down doesn't mean all crypto assets are trending down. If you look, you'll still find altcoins with green candles and an uptrending market structure, even in brutal BTC downtrends. Just be conscious of the fact that such outperformance typically doesn't last very long, so it's probably best to treat those altcoins as shorter-term buys if you're getting involved. Now, it may seem foolish to look for long opportunities in a market that's generally trending down. However, bearish phases are only ugly because losses are concentrated in a handful of violent legs. Between these legs, however, you get a surprising number of up days. That's why relative strength scanning works. Watch for tickers that hold higher lows on red days and outrun peers on bounces, then size them in a sane manner. Keep in mind that it's typically best not to view these as long-term trades. You're usually looking at an altcoin that's outperforming over a relatively short period. One other thing you need to keep in mind as you search for counter-trending assets is something simple but powerful, and that's that cash is a position too. In fact, it's sometimes the best one. Don't believe us? Just ask Warren Buffett. His holding company, Berkshire Hathaway, is currently sitting on a record cash pile approaching the $350 billion mark. That's a record in both absolute and relative terms based on Berkshire Hathaway's history. So, if the world's most famous capital allocator is opting to keep a ton of dry powder while waiting for the right opportunity, well, you're allowed to as well. Optionality has major value when markets are panicked or unclear. Okay, let's switch gears. The last method isn't an approach that prints gains during a market correction, but it is the most time-tested approach to generating profit from corrections: dollar cost averaging, or DCAing. This is one method many highly successful long-term investors use. And note that we're talking long-term investing, not short-term trading here. Dollar cost averaging just means you buy a fixed dollar amount on a fixed schedule, regardless of price. No glorious entries with bragging rights, just steady accumulation that smooths your average cost over time. No, it's not a way to get short-term profit during a downtrend, but in the long run, these are some of the best buys you'll ever make. But why bother DCAing when the chart looks awful? Well, because one of the hardest parts of markets is psychology. Downtrends force you to buy while it feels awful, and that's exactly when DCA earns its keep by taking timing off your plate. It's rules-based, it's boring, and it protects you from that one fatal decision, panic selling, after you've already sunk months of buys into an asset you swore you believed in. So, the real edge with DCA is conviction. That means if you're going to keep pressing the buy button while your feed screams doom, you should be doing it in assets you actually want to hold for years, not weeks. For most, that means sticking to the leaders, BTC and ETH, because a lot of alts simply never reclaim old highs once the hype cycle dies. Whole cohorts from prior cycles faded into irrelevance while the majors kept compounding network effects. Mechanically, it's best to automate your DCA strategy too. Most exchanges and apps let you schedule recurring buys, and that lets you deploy a fixed amount at regular intervals so you're not relying on willpower during the toughest times to buy. If you want to level up beyond the plain vanilla version, there are also a few tweaks that offer a different approach without turning it into day trading. Value averaging targets a portfolio value path rather than a fixed cash amount, nudging you to buy a bit more after big drawdowns and a bit less after sharp rallies. There's also threshold DCA, which keeps the timing cadence but adds a simple rule. Double your scheduled buy if price is down, say 20% from its 30-day average, or halve it if it's up 20%. You can tweak this approach in a million different ways, but the core idea is to keep adding with a tilt towards weakness while staying systematic. Whatever the approach though, here are some practical notes. First, pace your runway. If you plan to DCA for 9 months, don't burn through your allocation in 3 just because the first leg down was dramatic. Second, set some kind of invalidation, a fundamental break that stops the DCA strategy. If an asset's core thesis dies or liquidity disappears, you don't DCA into zero. Again, this is one of the reasons it may make sense to just put on your BTC maxi hat when it comes to dollar cost averaging. BTC is the most robust and battle-tested crypto asset. It's number one for a reason. And finally, zoom out. With BTC specifically, time in the market beats attempts at precision entries. Hold long enough and your entry matters a lot less than your ability to stay invested. Markets are tough. Red markets are very tough. Many scoff at DCAing, but countless highly successful investors swear by it. So put your ego aside and leave the bottom entry screenshots for crypto Twitter. Well, those are our top methods for calibrating our trading and investment efforts for red markets. Did we miss any? Do you have any techniques to share? Let us know in the comments below. And if you want to learn more about how to prepare for a bear market, you can check out our video on that right over here. That's it for today though. As always, thank you for watching and I'll see you next time. This is Guy, over and out.